Hey, it's Mike over at Cross Country Mortgage, and it is time for your Monday morning mortgage update for the week of December the 16th. Hope you all had a great weekend. A lot of rain out this weekend and snow in the mountains. Skiing has already started and got some nice powder. So let's talk about what happened last week, what's going to happen this week. I always try to give you insight about what's happening in the market so that when you're buying, selling, helping your clients, you can make intelligent decisions that impact your life. So last week, a 75 basis point sell-off in the market, meaning that rates got worse. Money flowed out of that bond market. We know that mortgage rates are determined by the trading of mortgage-backed securities in the bond market. So when money flows out of the bond market, it's not good for rates. Now, the week before that, we saw 65 basis point improvement. Money flowed into the bond market. So last week, we lost all the gains we got the week before and then some. Why? Inflation. Inflation is the death of mortgage rates. When inflation is up, mortgage rates are up. And it's obviously been the big issue for a long time. We know it costs more for milk and eggs, and that's not getting better. And the numbers that came out last week showed inflation where it was in April of this year. And that's not great for rates, obviously. It's not great for our pocketbooks. And why is that? Really, two main things. There's a lot of things, but two main things. Spending by the current administration and debt. Spending $9 trillion just in the last 4 years by the current administration. And we are higher in debt, and the interest we pay on that debt is massive. And it's just an issue that I'm not sure how it's going to be resolved. Maybe the new administration can make some headways on it, but that is really the primary thing that's driving inflation up. So let's talk about what we're looking at this week. We're looking at the Fed meeting that starts tomorrow and ends Wednesday. We're looking at inflationary numbers that come out on Friday and retail sales come out tomorrow on Tuesday. So Fed meeting, the last Fed meeting of the year, obviously an important one. Everybody expects the Fed to cut the Fed fund rate by 0.25%. Keep in mind, that doesn't mean interest rates go down by 0.25%. That Fed fund rate affects short-term rates, not long-term rates like mortgages, short-term rates like home equity lines, car loans, credit card rates, things like that. Also, the money that businesses are charged, or the interest that businesses are charged when they borrow money to operate their companies and their businesses. That now will most likely go down 0.25% on Wednesday. So that's good. That promotes spending. The other thing that's going to happen in this meeting is the Fed's going to come out with their economic projection for 2025. Really interesting projection. The last one they came out with was in July and showed that the economy was humming along, some issues, and it kind of changed the mindset of cutting rates. They actually started to cut more aggressively because of that economic projection. Things are a little bit different now. They're trying to project what's going to happen in 2025. How do they project what's going to happen when a whole new administration is going to be in place? And we don't even know, the bond traders don't know, which is really who's paying attention to this, what the current or the new administration's economic policies are going to look like. They can guess, but they don't really know. So the bond traders are probably not going to put a lot of weight in the Fed's economic projections coming out. The bond traders really, the Fed really won't know. None of us will really know what the new administration's economic policies are going to look like probably until February or March. But again, the economic projections will come out. Everybody will pay attention to them. The media will report those. We just don't know how it's going to impact the mortgage rates. The next thing is the PCE, the Producers Consumption Index. That is the main report that the Fed looks at to determine their policy. It is the main report on inflation. What is this number going to look like? There's 3 different reports that come out. This is the big one. It's coming out a little early this Friday because of the Christmas holiday next week, and everybody expects it to be up, means inflation is going to be up, and this is not good for mortgage rates. Higher inflation means higher mortgage rates. So we'll be paying a lot of attention to that on Friday. And then the last thing is retail sales. These are November's retail sales. That's coming out tomorrow. If the consumer bought a lot of stuff in November, that's good for the economy, bad for rates, mortgage rates. If the consumer spent under the expectations, that is good for mortgage rates. So again, this isn't really Christmas spending. Yes, people buy their stuff in November, but really the number next month that comes out for December will be the impactful number. So those are the 3 things. Tuesday, Wednesday, and Friday is what we're paying attention to. It's a very volatile week with probably more indication of a higher rates and lower rates. So we're floating cautiously today. Nothing's really happening on a Monday, and floating into any change in news will be really quick to lock our clients' interest rates. So a lot of pressure on the market this week. I hope to talk to you next week. Have a very productive week, and we'll talk to you soon. Bye-bye.